Welcome to the deep dive. Well, if you've been watching the markets this week, you definitely know we've had some serious volatility.
Yeah, pretty wild swings.
Absolutely. Resulting in really a brutal shakeout.
Yeah.
Over $1.7 billion in leverage positions just poof, wiped out.
Completely cleared out.
So our mission today is to kind of give you a clear map through all this wreckage. Because what we're seeing right now is, well, it's a bizarre and critical divergence.
It really is.
On one side, you've got this visible technical damage. I mean, the chart looks rough, let's be honest. But then running parallel, you have this powerful, really strategic wave of long-term capital coming in from some major corporate treasuries.
Big players making moves.
Exactly. So the market, it seems to have entered a bit of a stabilization phase. Currently trading around, what, 113,000, 151 wars, just holding above that $112,000 mark.
Right, clinging on to that level.
But the fundamental question, the one facing every investor, is pretty simple. Which force wins this tug of war? Is it the short-term technical mess, or is it this long-term corporate conviction?
And that deleveraging event, clearing out that $1.7 billion in speculative leverage, people often call that a necessary shakeout.
Right? You got to clean house sometimes.
Yeah, it purges the excess. And theoretically, at least, it sets a much healthier foundation for, sustained growth down the line.
Okay, a necessary shakeout, maybe. But when you actually look at the price chart, it feels like that short-term damage hit pretty hard. We saw some real technical levels just break.
Oh, absolutely. That shakeout definitely came at a cost. We've seen some consolidation over the past 24 hours, sure, but the technical picture, it's definitively worsened.
How so?
Well, we saw a clear break below the 50-day exponential moving average, the 50-day EMA. That was acting as pretty strong support near $115,000 before.
Right.
And now that $115,000 level, it's effectively flipped. It's become this new heavy ceiling of overhead resistance.
Okay, so support becomes resistance. Classic technical pattern.
Exactly. Now, immediate support, it's clustered pretty tightly. It's holding that session low of $111,998 and, critically, that psychological line at $112,000. Okay. But looking up, that first major barrier now is $114,000. And that lines up pretty neatly with a short-term descending trend line that's, putting pressure on the market.
Right. Okay, and this is where I think the technical picture gets really fascinating. It kind of defines the stakes of this whole conflict, doesn't it?
It does.
For you to understand where the true floor might be, we actually have to look beyond just the simple charts to an on-chain measure. It's called a short-term holder cost basis, or STH cost basis.
Yeah, that STH cost basis, that's really the new bull-bear dividing line. On-chain analytics, they place this aggregate price at approximately $111,400.
So what did that number actually represent? $111,400.
It's basically the average price paid by every single market participant who bought Bitcoin within the last 155 days. So all the recent buyers.
Got it. The newcomers, essentially.
Pretty much. And the fight is happening right here, right now, around this level. If the market holds above $111,400, well, that proves the recent dip buyers, the long-term believers, they're strong enough to absorb this volatility. But if we see a sustained price below that level, that means a huge group of fresh buyers immediately fall into an unrealized loss. And that increases the risk of another wave of selling, panic selling, potentially.
Right, because nobody likes being underwater right after they bought in.
Exactly.
Okay, but what's really remarkable, given all that internal technical weakness we just discussed, is the broader macro context. It's kind of weird.
How so?
Well, while our market was busy, setting itself on fire and clearing $1.7 billion in longs, traditional risk assets, things like U.S. equities, even gold, they were hitting new all-time highs.
Interesting divergence there.
Totally. And that tells us something vital, I think. The risk-on global environment. It's still intact. Our downturn, it seems, was driven purely by the internal structure of the crypto market, just too much leverage.
Yeah, not by wider systemic fear about the economy or anything like that.
Exactly. It was an internal problem.
Yeah.
And crucially, that dip was bought.
Yeah, the buying response was pretty immediate, actually, especially from U.S. investors, it seems. We saw the Coinbase Premium Index jump into positive territory right during the selling pressure.
And what does that mean, the Coinbase Premium?
It basically means that the regulated U.S.-based exchanges like Coinbase were seeing stronger buy-side pressure, higher prices effectively than offshore venues. That's usually a sign of serious high-conviction money stepping in, institutional or corporate money.
Okay, high conviction. And that conviction, it's really showing up in some, frankly, stunning corporate moves.
Yeah.
This provides that powerful counter-narrative to all the liquidation chaos.
Mm-hmm.
It feels like we were officially entering maybe phase 3 of corporate adoption. It started with this simple cash conversion, right?
Right.
Then it became passive holding.
Just sticking it on the balance sheet.
Yeah. And now it seems like it's about active strategic investment management.
Absolutely. And the biggest headline recently really underscores that. It came from Strive, Inc. They announced an all-stock merger with Semler Scientific. Now, this wasn't just some ordinary merger. They specifically designed the new combined entity to create a scaled Bitcoin acquisition platform. That's their term.
Wow. A Bitcoin acquisition platform. And the goal is to generate alpha, and I'm quoting them here, outperform Bitcoin through a corporate structure.
That's right.
And that's a profound shift, isn't it, compared to just a few years ago?
Oh, it's night and day. It really speaks to the maturation of Bitcoin as a, strategic treasury tool. This combined entity, they're expected to hold over 10,900 Bitcoin.
10,900, okay.
And concurrent with that merger announcement, Strive went out and purchased an additional 5,816 Bitcoin for $675 million.
Whoa.
Yeah, and they executed that trade at an average price of $116,047. So right into that initial volatility, buying the dip, essentially.
Bold move.
And it's not just a U.S. thing either. You look internationally, Japanese firm Metaplanet, they're a major player. They just executed their largest purchase ever, 5,419 BTC for $632.5 million.
Goodness. What's their total now?
Their total holding are now at a massive 25,555 Bitcoin.
25,000.
Okay. And of course, you've got the steady hand of MicroStrategy just continuing its accumulation. They added another 850 BTC for about $100 million recently.
Okay, so that's just a huge wave of strategic long-term accumulation happening. But we have to acknowledge the other side, right? Especially in the institutional world. Corporate treasuries are one thing, but those institutional exchange-traded funds, the ETFs, they told a bit of a different story on Monday, didn't they?
They certainly did. Yeah, while these corporate treasuries clearly saw an opportunity, the institutional spot ETF flows, they showed significant net outflows for Monday, depending on the data source. Somewhere between $363 million and $439 million flowed out.
Wow, so almost $500 million out, while corporates were buying hundreds of millions.
Exactly. And it highlights a key difference, I think. Corporate treasuries, they tend to be fundamentally long-term strategic holders. Many ETF holders, though, especially maybe those focused on short-term performance metrics, they were clearly a source of selling pressure when that volatility cascade hit. They de-risked.
That makes sense. Different mandates, different reactions.
Precisely.
And it's also important to note, corporate strategies are getting more diverse, too. Not just Bitcoin anymore, is it?
No, not entirely. We even saw Phoenix Motor, for example, expanding its payment options and its treasury management to include a basket of assets. They mentioned Ethereum, BNB, and Solana specifically, moving beyond just a BTC-only standard.
So that signals that the broader asset class, not just Bitcoin, is maturing in the eyes of, corporate finance officers.
It definitely shows a broader acceptance of digital assets as a, let's say, treasury diversification tool.
Okay, so we have this undeniable corporate conviction building, but that still doesn't fix the damage done to the short-term chart, right?
No, it doesn't.
Let's go back to the derivatives market then. What state is it in now that all that speculative air, that $1.7 billion, has been cleared out?
Well, the good news, I suppose, is the market is now less susceptible to those cascading liquidations simply because so much leverage has been fleshed out.
Fewer dominoes left to fall.
Exactly. But the initial crash did cause a noticeable flight to quality. We saw capital rotate out of altcoins pretty sharply and go straight into Bitcoin. Bitcoin dominance, it rose to 57%. And that altcoin season index, which measures altcoin strength versus Bitcoin, it dropped sharply, went from near 100 down to about 65.
So Bitcoin acts as the sort of digital reserve asset during stress.
In the crypto market's financial structure, yes. But despite that reset in the futures market, we have a major options headwind coming up this week, the September 26 options expiry.
Okay, that's effectively Friday, right?
Yeah.
What kind of gravitational pull does an expiry like that create?
Well, the options market seems to have a gravitational center right now around $110,000. That's known as the max pain price.
Max pain sounds ominous.
It just means that's the price level where the maximum number of options contracts both calls and puts expire, worthless. So until Friday, the market makers who sold those options, they have an incentive to hedge their books in a way that tries to pull the spot price towards $110,000.
To minimize their payouts.
Right. Exactly. So it creates this sort of short-term uncertainty, and it can act as a cap on any potential upside momentum we might see this week.
Okay, so that sounds maybe a bit bearish for the immediate outlook, just for the next few days.
Yeah.
But if we look past Friday, past the expiry, are derivatives traders positioning for continued weakness? Or
Actually, quite the opposite. Looking past this immediate expiry risk, derivatives traders are actively building bullish positions for Q4.
Oh, interesting.
Yeah, the data shows pretty strong demand for October call options, specifically in the $120,000 to $125,000 strike price range.
Wow, okay. So they seem to be viewing this current price weakness as maybe just a staging ground, a temporary dip before a potential breakout later this year.
That seems to be the positioning, yes, viewing the dip as an opportunity for longer-term plays.
And meanwhile, while all this, financial volatility is happening, the underlying infrastructure, the nuts and bolts of the market, it continues to mature. It keeps pushing towards compliance and institutional readiness.
That's a really critical point. You look at, say, the derivatives exchange Flipster. They just launched the market's first perpetual contracts that are quoted and collateralized against USD1.
USD1.
Yeah, that's a regulated stablecoin from World Liberty Financial, or WLFI.
Yeah.
This is a clear attempt to build, compliance-focused infrastructure, something that might attract more institutional, maybe more risk-averse capital, people who prioritize regulatory clarity over, chasing the highest yield offshore.
Right. It's all about making Bitcoin and these related assets properly financeable within traditional institutional frameworks. And we saw more evidence of that sophistication in the mining sector too, right? Which is so central to the network's operation.
Absolutely. CleanSpark, a major U.S. mining operation, they just secured an additional $100 million Bitcoin-backed credit facility from Coinbase Prime.
Was borrowing against their Bitcoin holdings.
Exactly. And this really demonstrates Bitcoin's maturation as a truly financeable asset. Miners can now fund their growth, their investments in new machines, their operations, without necessarily having to liquidate the Bitcoin they produce day to day.
Which insulates them from having to sell into volatility, like we just saw.
Precisely. It strengthens the whole ecosystem, makes miners stronger holders.
Okay, so if we try and synthesize all of this, you've got severe technical damage on the chart. You've got multi-million-dollar corporate accumulation happening almost simultaneously. You've got this short-term options headwind pushing down towards $110, but then this resilient infrastructure continuing to mature underneath. It feels like the market is truly at a defining inflection point.
It really does feel that way.
Long-term fundamental conviction is just clashing directly with short-term financial damage from that leverage washout. So what does this all mean for you, the person watching the market minute by minute? The reports we looked at identify 3 absolutely critical catalysts that you need to monitor. These will likely determine the market's direction for the rest of the quarter.
Yeah, these are really the 3 signals that will tell us whether those corporate buyers are actually strong enough to absorb the selling pressure and turn things around.
Okay, what's number 1?
Number 1, the battle for the STH cost basis. You have to actively monitor the defense of that $111,400 on-chain level we talked about.
Right, the average price for recent buyers.
Exactly. A failure to hold that level would signal that the recent dip buying, well, it just wasn't sufficient to counter the initial downward momentum. Holding it is key.
Okay, STH cost basis. What's number 2?
Number 2, daily U.S. spot ETF flow data. You really need to gauge whether Monday's large outflows, that $363 million to $439 million range, was just a one-off event, driven by panic from the leverage cascade, or if it's the start of some kind of systematic institutional de-risking.
So we need to see if the bleeding stops.
Basically, yeah. A quick return to net inflows would be a really powerful recovery signal. Continued outflows would be concerning.
Got it. And the third catalyst?
Third, pre-expiry positioning. Just keep watching the hedging activity closely until that September 26 options expiry is fully resolved, until Friday passes. That event removes the $110,000 max pain gravitational pull we discussed, and just the removal of that uncertainty could unlock the market's true direction as we head into Q4.
Okay, so watch $111 SOR case, watch the ETF flows daily, and watch how things shake out after the options expiry on Friday. That summarizes the core tension perfectly, I think. Despite a leveraged crash causing real technical damage, you have strategic corporate treasuries treating this volatility as a key accumulation opportunity.
Yeah.
It's a genuine test. Long-term conviction versus short-term financial momentum.
It really is. And maybe here's a final provocative thought for you to consider as we wrap up. Despite all the significant price volatility, the liquidations we've seen, the fundamental health of the underlying Bitcoin network itself remains robust. Key metrics, like the network hash rate, it's steady around 1,090 exashares per second. Active addresses are holding around 535,000 per 24 hours. These things underscore a critical point.
Oh.
The recent sell-off was purely a financial market event. It was completely detached from any kind of protocol instability or failure in the network itself.
Right. The network didn't flinch.
Not at all. And this raises, I think, an important question. When the internal financial structure drives price action so heavily, like it just did, how long until that underlying fundamental strength reasserts itself and overcomes the short-term financial chaos? That's something to mull over until our next deep dive.